If you're thinking about investing in 2026, but you're worried about risk, you're not alone. A lot of beginners believe the stock market is basically gambling. Others think investing is only for financial experts or wealthy people. And the biggest fear is always the same. What if I lose my money? The truth is, investing doesn't have to be reckless or complicated. With the right strategy, beginners can invest in a way that balances low risk with long-term growth. Today, I'm going to walk you through some of the best investments for beginners in 2026 that are simple, practical, and designed to build real wealth over time. Let's start with one of the safest and smartest options for beginners: index funds and ETFs. ETF stands for Exchange Traded Fund. In simple terms, it's like buying a basket of stocks instead of just one company. When you invest in a broad market ETF, you're instantly buying small pieces of dozens or even hundreds of companies at once. This is powerful because of diversification. If one company struggles, others can help balance it out. Instead of trying to guess which single stock will win, you're investing in the overall market. Historically, broad market index funds in the US have delivered steady long-term growth. They're not flashy, they're not exciting, but boring investments often build the most wealth. Another strong option for beginners is blue chip stocks. These are large, well-established companies with strong reputations, stable earnings, and long track records. Think companies that have survived recessions, economic downturns, and market crashes. They're typically less volatile than small speculative stocks. That doesn't mean they can't drop in price, but they tend to be more stable over time. For beginners, this stability can make it easier to stay invested during market swings. You probably won't double your money overnight, but steady growth combined with patience is how long-term wealth is built. Next, let's talk about dividend stocks. Dividend-paying companies share a portion of their profits with investors on a regular basis. That means you're not just waiting for the stock price to rise. You may also receive consistent payouts. For beginners, dividends can be motivating because you see actual cash flow coming into your account. And if you reinvest those dividends, compounding becomes even more powerful. Over time, your investments start generating income, and that income buys more investments. This is one of the foundations of building passive income through the stock market. Now, before you focus only on growth, there's something extremely important: safety and preparation. If you're just starting out, you should have an emergency fund before aggressively investing. Ideally, 3 to 6 months of living expenses in a high-yield savings account or money market account. These options won't give you high growth, but they provide stability and protection. If an emergency happens and the market is down, you don't want to be forced to sell your investments at a loss. Smart investing always starts with a strong financial foundation. For beginners who want a little more growth potential, you can consider allocating a small portion of your portfolio to growth-focused ETFs or sectors like technology, artificial intelligence, renewable energy, or innovation funds. In 2026, these sectors continue to expand and evolve. However, the key word here is balance. You don't put all your money into high-growth investments. A smarter approach might be keeping the majority of your portfolio in broad index funds and stable assets, while using a smaller percentage for higher growth opportunities. That way, you participate in potential upside without exposing yourself to extreme risk. It's also important to understand that low risk does not mean zero risk. The market can drop 10%, 20%, or even more in certain years. That's normal. Historically, the US market has gone through recessions, crashes, and corrections, and it has recovered over time. The real danger isn't the market itself, it's emotional decision-making. Many beginners panic when prices fall and sell at the worst possible time. Then they wait too long to re-enter and miss the recovery. The investors who build wealth are usually the ones who stay consistent and patient during downturns. So what might a simple beginner strategy look like in 2026? You could consider allocating 60-70% of your portfolio to a broad market index fund or EF, then 20-30% to blue chip or dividend-paying stocks, and maybe 5-10% to higher growth sectors if you're comfortable with slightly more volatility. The exact percentages can vary depending on your risk tolerance, but the principle is balance and diversification. On top of that, invest consistently. This strategy is known as dollar cost averaging. Instead of trying to time the market, you invest a fixed amount every month. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this smooths out volatility and reduces stress. One major mistake beginners make is chasing hype. Social media makes it easy to get caught up in trending stocks or can't miss opportunities, but investing based on hype is rarely sustainable. If something sounds guaranteed or too good to be true, it usually is. Building wealth is typically slow and disciplined. It doesn't rely on viral moments. It relies on consistency and long-term thinking. Let's also talk about realistic expectations. Historically, an average annual return of around 8-10% in the stock market has been considered strong over the long term. Some years will be higher, some will be lower. But if you consistently invest and allow compounding to work for 10, 15, or 20 years, the results can be significant. Compounding may seem slow at first, but over time, it accelerates. That's why starting early, even with small amounts, can make such a big difference. In 2026, the best investment for a beginner isn't the one with the highest possible return. It's the one you can stick with, the one that lets you sleep at night, the one that encourages consistency instead of fear. Wealth is a marathon, not a sprint. If you focus on diversification, long-term growth, emotional control, and steady contributions, you put yourself in a position to succeed. If you're serious about changing your financial future, don't wait for the perfect moment. There will always be uncertainty. Start with a simple, balanced strategy. Invest regularly, ignore short-term noise, and let time do the heavy lifting. The goal isn't just to make money in 2026. It's to build a system where your money works for you for decades to come.